I read Neil Shearing's book, The Fractured Age, over the Christmas break. Shearing is the chief economist at Capital Economics, the macro market research business, and he authored this book in the middle of last year. It covers some really important points in my view in relation to both the path of global trade patterns and geopolitics over the coming years. He lays out his view that the era of globalisation has come to an end, but that the world is not necessarily deglobalising, but instead fracturing along fault lines often associated with energy, critical minerals, and of course security. Understanding this fracturing will be critical for policymakers and corporate leaders, but of course also investors in navigating the future. I was already a good way through this book when the events in Venezuela unfolded at the very start of the year, making the publication even more topical than it already was. There are lots of hugely important trend changes underway at the moment, and in a repeat of some of the episodes we recorded this time last year, we'll be kicking off 2026 with a couple of interviews with market strategists and economists to discuss the macro outlook for the year ahead and beyond. For the first of these, I was delighted to get some time with Hugh Gimber, the global market strategist at JPMorgan Asset Management. Welcome to the Investor Insights podcast, hosted by Killik & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik & Co YouTube channel, or by searching for Killik & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan, and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In this week's episode, the first of the new year, we were joined by Hugh Gimber, an executive director and the global market strategist at JPMorgan Asset Management. Hugh is responsible for generating fundamental analysis on the global economy and markets. And prior to joining JPMorgan Asset Management, Hugh worked as a multi-asset investment strategist at BlackRock. Hugh is a regular commentator on both national and global financial news channels and is a highly regarded public speaker. At this time of year, we take a step back from our regular discussions with portfolio managers on the Investor Insights series and take a look at where things stand from a top-down perspective and what potentially lays ahead for the coming year. We discuss several really important topics in this episode. Hugh lays out his team's broad outlook, as well as, of course, discussing the recent events in Venezuela, before addressing some of the key risks currently being debated by market participants, before we try to start to assess what this means for portfolio construction moving forward. I was delighted to be joined by Hugh to record this discussion, and I hope you enjoy the episode. As always, please do get in contact with us if you'd like any further explanation on any of the topics discussed. Hugh, good afternoon. Thank you so much for sparing some time for this. How are you doing today?
I'm very well. Thank you for having me. Excited to get going.
Yeah, lots to talk about. So we've got this kind of standard opening question to these, and all it kind of really aims to do is get a bit of an insight into kind of how you go about things really and kind of how you go about your work. We ask kind of if there's an anecdote from a recent meeting, or if you could give us an insight into a research project you're doing, or even just an article or book that you're reading. And we've had some book recommendations in here. Anything you can share just to kind of get us going?
Yeah, of course. I guess so I'll start with my favorite book from last year. I read Supremacy by Parmy Olson. And if you may have read it, if you're interested in AI, I thought it was a really good look at how some of the biggest AI companies today started out, how they've changed over the years, how big corporate influence has maybe shifted some of their goals, and gave me a really interesting historical perspective that I hadn't really seen. In terms of a recent meeting, I thought I'd take you inside the way that we pull together our outlooks, our mid-year outlooks or our annual outlooks here at JPMorgan. And these are some of my favorite meetings of the year because we basically stop everything for 2 days at a time. All of my European colleagues get together in a fairly small, uncomfortable room, and we sit there and we just thrash things out. We try and think about the key macro events that are coming up, where we have really strong conviction on areas where perhaps we don't have conviction, and where we stand relative to consensus as well. And this all happens about 4 or 5 weeks before we actually publish anything. But they're my favorite meetings of the year, because we just say, right, everything else is parked. Let's really get into the big issues that our clients are dealing with, and spend the time kicking the tires. I think it's a really good and fun process.
Yeah, thank you for that. Yeah, great to have a book recommendation in the first episode of the year. So thank you for that. Yeah, you mentioned that kind of end of year piece, that kind of outlook piece, and it is that time of year, isn't it, where your team obviously do one bit and your peers do a similar thing. I wondered if I could kind of ask you to kind of give a kind of brief summary of some of the kind of key points that were in that. I know you titled it "Fuel in the Engine," kind of explaining that resilient market performance because of the monetary and fiscal stimulus that we've had. But we'll maybe dive into some specific areas a bit later. But could I ask you to maybe summarize that piece if you can?
Of course, I guess the crux of our argument, before I go any further, I should say we had to be really careful with this outlook to not write about what we thought the global economy needed to be seen in terms of policy this year, but rather what it was going to get. Because in our types of seats, it's always very tempting to say, we think interest rates should change by XYZ, or we think fiscal stimulus should do this. But sometimes that misses the point, because sometimes you spend too much time forecasting what you think would be right to see and not enough time thinking about what we're going to see. So fueling the engine is all about the stimulus that is going to be delivered to, frankly, what is already a fairly healthy global economy. If I look just at the first quarter of this year, the impact that the US fiscal position, basically government spending, is going to have on growth is going to be about as big as we've seen outside of the pandemic since the third quarter of 2009, when you were in the depths of the financial crisis. In other words, we have emergency levels of stimulus hitting an already healthy US economy, and therefore for growth, we think that gives you a pretty good picture, because there's going to be money going back to US consumers. And if there's one thing the economics community gets right, it's that if you give Americans cash, they tend to be pretty good at spending it. It's not true in the UK or in Europe, where people are much keener to save. Generally, when Americans have money in their pocket, they get out and spend, and that drives growth. So broadly, that's the picture in the US of government support and lower interest rates helping the economy. And in Europe, we have a similar story. Germany making big changes last year to finally put to work some of the money that they'd been really saving up since the financial crisis with their big infrastructure plan. Obviously, in the UK, slightly less wiggle room for the government to be spending big, but still, we think interest rates coming down gradually will also be helping growth. So this fuel in the engine analogy is really all about the stimulus, as you say, and we think it's going to be coming, whether that's through more government spending or indeed lower interest rates, despite the fact that the economy generally looks to be in an okay place at the moment.
Yeah, no, thank you for that. Yeah, good summary to start. I mean, we're recording this the 14th of January, but already in that kind of first 2 weeks of the year, there's been just seems like just such a huge amount of news flow already, whether it's kind of geopolitical news or some policy changes, a lot of it kind of stemming or coming from the US. But I mean, I know it's a big question and ever moving kind of day to day, but what's been some of your early kind of takes on some of this? I mean, Venezuela being kind of probably the biggest story at the moment. Is any of this kind of required you to change any of that outlook? Any kind of early thoughts you can give us on any of this stuff?
Yeah, we've definitely been kicking the tires on how this could impact our outlook, but this has been another really good example where markets tend to do a pretty good job of differentiating between geopolitical events that don't have a major economic impact and those that do. Because it's the geopolitical issues that lead to a change in the economy that tend to make markets react. And when we look at somewhere like Venezuela, I don't want to ignore all of the changes that we're seeing on the ground and the geopolitical significance of what's going on. But economically, there isn't a major change in our global outlook as a result of what's happened. And I know lots of people are thinking about the consequences for oil markets, for example. Over the next 10 years, this could be really meaningful. But despite all of the natural resources that Venezuela is sat on at the moment, their production capacity just isn't there to be able to see a big shift in how much oil they can be providing to the world anytime soon. So when that news broke, we got together as a team, we went through where could there be an economic impact, and commodities often are where you see it first when it comes to geopolitics. But our conclusion, and I think the market's conclusion, was that frankly, our global economic view for this year has not been materially changed so far as a result of some of the geopolitical shifts that we've seen.
Yeah, I guess there's that debate between the kind of short term and what potentially could come much, much further out, I guess, in the longer term. Yeah, that makes sense. And just kind of looking through that outlook piece that you wrote at the end of last year, I mean, it, and some of your kind of more recent commentary, I mean, it talks about some of the risks that you see associated with the current environment, and one of them, I think you call them potential derailments in your outlook piece, and there's a few that you highlight, but one of them is related to whether this stimulus that you mentioned in the answer to one of the first questions will lead to an asset bubble, and I guess that kind of instantly takes you to equity valuations, which are much talked about, and the AI sector in particular, where you've just seen kind of ever increasing capex. So could I ask you to maybe talk about that risk that you see and kind of how you're looking at that area?
Definitely. So, in terms of that idea of excess stimulus hitting an economy, we really have four good examples of this over history. And two have created asset price inflation, and two have created consumer price inflation. So, you look at the 1920s or the 1990s as examples of building asset bubbles that subsequently burst. And then you have the 1970s or the early 2020s as that more inflationary environment from a consumer price inflation perspective rather than creating asset bubbles. So when it comes to tech, I'm not going to be able to answer today whether tech is in a bubble or not, because generally that is an impossible question to tackle in real time. It can be pretty tricky, frankly, until you have the benefit of hindsight. But what do we know today? Well, first, we know that tech valuations are undeniably high. If I look at just the biggest 10 stocks in the US equity market, they're trading on a valuation of close to 30 times, just about 29 times today. That is a big number. That demands a lot of earnings growth in the future for those companies to continue to deliver a healthy return. And so if we're going to see that earnings growth, the main point we tried to highlight in our outlook is that this is less about what the tech companies are telling you. We should be paying attention rather to what other companies are telling you about how they're using AI. I just take a recent example from the last earnings season. The Nvidia CEO said AI is definitely not a bubble. We're not seeing that at all. And I have a huge amount of respect for Mr. Wang, but I don't think he's going to be the first one to tell us whether AI is in a bubble or not because of where that company sits. So what we're instead trying to grapple with is where are there companies in, say, the financials or healthcare or manufacturing that is showing really strong demand for this that can justify all of the early capex, which is being put in place by what's known as the hyperscalers, think the Microsofts, the Amazons, the Apples of the world today. So although we still have pretty limited visibility on that level of demand, that's going to be a key area we're tracking this year. I'd also say I think a big shift in 2026 will see investors moving away from viewing AI companies as one single collective group and starting to think the layers a bit more. So where you sit along that AI supply chain can leave you very differently exposed to the high levels of investment that have been put in place today. Let's take the scenario where CapEx has been too big. Companies have invested too much in building out new computing capacity. Let's say too many data centers are going to be built around the world. In a few years' time, if that scenario plays out, that would be really bad news if you're a chip manufacturer, because the demand for new chips to build even more data centers is going to come down because we simply won't need as many as previously predicted. But if you're a user of what those data centers are providing, i.e. computing capacity, that's great news because your costs are going to be coming down. And the amount that you have to pay the data center providers is suddenly going to tank because there's too much capacity. And we know if there's a big increase in supply, then generally that's going to push prices down. So this, I think, is where the market's starting to do a better job of not just saying, is AI good or bad, and therefore should tech companies be going up or down, but rather starting to say, where do companies sit within this ecosystem? And are we going to see winners or losers within the chip manufacturers? Or maybe it's about being a user of computing capacity rather than a provider of computing capacity. Getting a lot more granular, I guess, is the bottom line.
Yeah, thank you for that. Always more nuanced and often within the market, there's lots of dispersion in valuations and that sort of thing. I mean, given you kind of laid out in the last few questions your outlook really well. I mean, given the kind of backdrop that you've just laid out, could you maybe talk us through some of what you see as the kind of primary considerations in relation to constructing a portfolio at the moment? Kind of what are you focusing on?
Sure. I'll raise 3 points here. So the first, when it comes to risk assets, I think is all about your regional allocation. Because we know passive equity investors, if you've chosen to invest in, say, a global index of stocks, have seen allocations to US companies rise very substantially over time, just as those global indices have become more and more dominated by a small number of US companies. So the first thing I'd be thinking about in terms of portfolio construction this year is, do you have enough in risk assets outside of the US if our view on broadening global growth regionally and broadening growth across sectors plays out? Because if you're just reliant on that allocation you're being handed by MSCI World, which is very, very US centric, might you be missing out on some better opportunities around the world if, as I say, we're right that regional growth is going to look a lot stronger? So that would be point number one. And then when you use the term portfolio construction, I immediately think, well, how are you pairing risky assets like equities with the assets that you want to offer some defense against some of the downside scenarios for this year? And we called out two in our outlook, as you mentioned. So one would be a big tech disappointment. Let's say the AI story does turn out to be too enthusiastic and investors change their view on how optimistic they want to be about tech. In that scenario, we think government bonds would protect a portfolio very well. Because if you see AI spending pull back, not only would share prices be coming off, and that would be hurting the US consumer, but companies would be less inclined to invest as well. So quite quickly, you go from a very strong US economy to start thinking much more about a potential recession. And in that version of the world, we think government bonds would prove to be a very effective hedge. I think the hardest thing about portfolio construction today is that it's not only growth concerns that you should be thinking about. There are inflation risks as well that come with all of this excess stimulus. And to protect against inflation in a portfolio, you can't just rely on stocks and bonds. 2022 is a very good example of this, when you had a big inflation spike and stocks and bonds were hurt at the same time. There you needed real assets. You needed commodities. Even something like the UK equity market, given its sector weight, proved to be much more defensive. So I guess three key themes to highlight. One, think globally and think regionally within equities. And then when it comes to diversification, two, think government bonds for recession risk. And then three, think real assets if it's inflation rather than growth that knocks the story off course this year.
Yeah, I mean, you mentioned there about diversifying risk assets away from the US, or not being so reliant on the US. I mean, that kind of the other element of the debate here is around the US dollar. I know this is kind of a huge topic, lots of moving parts to this, but I know your team wrote a paper again. I think it was the end of last year about this debate about the US dollar weakening. Could I ask you maybe to summarize some of the key points there around the kind of path of the dollar at the minute?
Of course. So in that piece, we basically went through why we think the dollar had appreciated for such a long time, and then really tried to interrogate each of those catalysts that we'd seen historically for a stronger dollar. So those were: one, the US economy growing much more quickly than the rest of the world; two, the US economy having much higher interest rates than the rest of the world; and then three, what I describe as institutional credibility. The knowledge that the US gives you the best protection when it comes to the legal framework around owning assets. And you know that in times of crisis, everyone's going to flood to America for safety, and therefore you're going to get that kind of diversification benefit effectively from the US dollar. So we think the dollar is likely to continue weakening from here because we think each of those three pillars are now looking less robust. On growth, it's not to say I don't think the US economy can have another good year, but I've briefly mentioned earlier we think actually around the world, there's a bit more room for upside surprise. And so maybe the US economy is still growing more quickly than many other regions, but the gap is getting smaller. In other words, what I'd call the growth differential is starting to shrink and therefore is not working as favorably for the US dollar. I think the same story is true on interest rates. So I believe that US interest rates will be coming down in 2026. If I compare that to, say, what's happening in the Eurozone, the ECB looks to be on hold for the foreseeable future. So yes, US interest rates are still going to be higher, but probably, again, that differential, that gap is likely to be shrinking. And then institutional credibility, we could debate for hours and probably not get to a firm conclusion. But I think all of the stories that we're seeing at the moment around, changes in the Fed and US trade policy, they're certainly proving to be a catalyst for international investors just to revisit how concentrated they want their portfolios to be in US assets. If you're an emerging market central bank, how many of your holdings do you want in US treasuries? Or do you just want to be sharing that around a bit more? Do you maybe want to be thinking about using a bit more gold instead of really a sole reliance on US assets? And as that mindset changes, that tends to drive assets out of the US and into other parts of the world, again, putting some downward pressure on the dollar. So we don't think the moves in the US dollar are likely to be as large this year as they were last year, but we do think investors should be preparing for further dollar downside. And that's a really big deal for sterling investors, because just look at what happened in the US markets last year. US equities had a really strong year, but if you subtract what happened to the currency, then in sterling terms, you're left with a much less impressive result. So that currency thinking and that currency decision is being a much bigger factor for sterling investors or euro investors, really at any point since the financial crisis.
Yeah, thank you for that. Some really important points in there. We've got a little bit of time here at the end, and what we've done with some of these some of these interviews in the past is kind of throw some quick fire questions at you, if I may. And I hope these aren't the trickiest of the set, but one of them was what you see as the kind of most concerning tail risk at the moment within markets. Is there something that kind of is keeping you up at night, or you see out there as being kind of the highest potential risk?
Yeah, we spend a lot of time thinking, where could we be wrong? And frankly, I think the easiest way for my outlook to be wrong this year is if inflation accelerates by more than I expect. Because we have the US government spending hard, we have US interest rates coming down. Both of those things rely on the bond market being well behaved and inflation staying relatively well behaved. So if inflation starts to pick up, the Fed is going to have to answer a more difficult question, right? They're going to have to say, yes, we know inflation is rising, but can we still really attribute this to one-off effects related to tariffs? If yes, fine, we can keep lowering interest rates. But if we start to see what economists sometimes call second round effects, in other words, people going to their bosses and saying, have you seen the cost of oranges? I need more money. And wages start to pick up. And then as wages start to rise, people spend more and inflation goes again. That would be a big concern. So inflation, I think, is the key tail risk that we're certainly monitoring most closely.
Yeah, 100%. And the next quick fire question is what you consider to be your kind of least consensus view. Again, it's that time when everyone's kind of putting out outlook pieces. But what do you think your team is kind of least consensus on?
Sorry, I need to remember quick fire on this. And the short version here is Europe. We think people are too negative about Europe. Everyone's telling us that European companies are never going to grow earnings. The economy is going to have another bad year. Germany's not really going to spend that money, or if it does, it will all leak to the US. We think expectations are low. The Germany's fiscal pivot is like nothing we've seen since the start of the euro. And there's plenty of room for upside surprise for European growth in 2026.
Yeah, absolutely. That goes back to that first question. Stimulus is not just a US story. It's kind of a lot of places in Europe as well.
Exactly.
And going back to kind of asset allocation, I mean, what would be your highest conviction area or strategy at the moment?
Yeah, I'd call out quality here as a style across equity markets.
Okay.
Because last year, if you just look at headline numbers for global equities, things look great, but it was a low quality rally. It was what some of my colleagues here are calling memes and themes. people latching on to ideas that sound catchy and rushing to try and beat their counterparts to buy them, higher quality companies underperformed substantially last year. In fact, at one point, it was the biggest drawdown for higher quality companies over a 12-month period since 2004. And I don't think this is an environment where we should be overlooking fundamentals. If you've got a strong balance sheet, if you can deliver stable earnings over time, I believe that companies like that will outperform consistently. And therefore, I would not be chasing this kind of low quality cyclical dash to get your hands on the worst stuff you can find because it might bounce the hardest. I think this would be a year where quality fundamentals really do reassert themselves.
Yeah, absolutely. A reminder that those kind of stylistic areas of the market go through periods of kind of peaks and troughs in sentiment. Yeah, absolutely agree with that. And last one, if you were to kind of look forward at the next 12 months, is there a kind of a macro event or something that you put in the schedule and blocked out as being kind of the most impactful? What are you looking for in 2026?
This is an interesting one. I suspect the biggest event is one that we don't actually know is coming yet. But one that we definitely do is the midterm elections.
Yeah.
And I would call these out, not because I think the midterm election result is going to be dramatic and really exciting and change everything, but rather I think they are going to be the lens through which you need to be understanding all US policy decisions over the next few months. So are we going to get more fiscal stimulus ahead of the midterms? We think yes. Is it going to change the relationship between the White House and the Federal Reserve? Perhaps. Will it influence US geopolitics around the world? Again, possibly. So I think the fact that they are looming just under 11 months out is going to have an impact all the way through this year. And you're going to have to look at how the US administration is making decisions through that lens from now, rather than saying, I need to pencil in November the 3rd now, because that's going to be a really exciting day.
Yeah, absolutely. Yeah, Hugh, really interesting to kind of whiz through your thoughts there. I really appreciate your time. Always interesting. Thank you so much.
Pleasure. Thank you for having me.
Thank you for listening to the Investor Insights podcast, hosted by Killik & Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik & Co. is authorised and regulated by the Financial Conduct Authority, the FCA.